Welcome to What's Brewing with IAT Insurance Group, where episode after episode we cover the latest marketplace trends with subject matter experts who are fueling our mission to provide insurance answers together. Grab your cup and let's settle in.
Hello, everyone. My name is Chris Accetta, and welcome to the What's Brewing Podcast. I'm the Vice President of Product Management at IAT Insurance Group, and I am joined today by my friend and colleague, David Geller, who is a Senior Product Manager in our Product Management and Underwriting Department, and is also kind of our in-house expert on insurance emerging issues. Welcome, Dave.
Hey, Chris. Good to be here.
Well, it's good to have you back. I said I wouldn't make a joke, but I'm going to anyway. I think we are the hosts so nice they asked us to do this twice. So it is a pleasure to be back on What's Brewing. And Dave, let's get cracking. It's 2025, new year. A lot of things happening in the industry. But I think I wanted to use some time today to talk about something that's been with us a while. It's not a new phenomenon, but it's something that is growing in both importance and I think observability, and that is social inflation. And what I was hoping we could do today, Dave, was kind of answer four key questions about social inflation. And with your help, hopefully we can get through all four and help our listeners better understand this phenomenon, what it can do to insurance results, and what risk selection methods can be used to help mitigate it. So Dave, if you're ready, let's dive right in. So first question, when we say social inflation, everyone's heard the word. What does that actually mean? Dave, can you kind of fill us in, give us any more information about that?
Yeah, if we want to start kind of at the highest level of social inflation, claims costs for over a decade now seem to be increasing above the regular economic inflation. And early on when this trend was being observed, it was hard to pinpoint the why. But over the last 5-10 years, we've, to your mention of observability, we've kind of seen the confluence of factors driving it up. We've talked about rollback of tort reforms. In the 80s, there was enactment of a lot of laws to help steer the liability insurance market back at a reasonable level. And when that happened, those reforms started to move back, and that opened the door up for higher caps on non-economic damages, longer statute of limitations, easier to file cases. And we've now seen in the last 10 years observable trends that have indicated this is contributing to social inflation.
Interesting. Everyone sort of knows generally what inflation is, right? We feel it in our pocketbooks. We feel it as insurers in the cost of materials, and we rebuild. It's traditionally been viewed as more, I think, of a property exposure or property phenomenon than it is on the casualty or liability side. Do you think that the prevalence of social inflation has anything to do with, as you hinted at, shifting attitudes in our culture, our society? Does it have are there legal system implications? I guess we got to it a little bit at the front. What are some of the factors that can contribute to social inflation?
Yeah, certainly sympathetic juries is a highly talked about, but also very unquantifiable topic. When, at least in the early observed days of social inflation, we were looking for causes, but it's become pretty clear last 5-10 years, there's definitely a mass, especially among younger individuals coming up, of anti-corporation sentiment. So plaintiff lawyers have done a really good job of kind of taking advantage of that and applying what's called like the reptile theory, which really hits at jurors' emotions, saying, hey, here's your chance to kind of get at the bad corporation.
Sticking it to the man, as it were.
Exactly. This plaintiff was injured due to their negligence. Give them the most out of that bad corporation's pockets as possible. Hit them where it hurts.
That's interesting because we see that parallel in a lot of things today. And like you hinted at, it's especially prevalent, I think, in a younger audience. There's a real appeal to attention and emotion. And, you see it in social media feeds all the time. You even see it creeping into things like LinkedIn where, if you can grab someone's attention for a few seconds and get them to click on your link or read your article, I mean, it's a very core appeal to our emotional side. It's a real separation from what might be logical. And, I think that, like you said, is really coming. Plaintiffs' attorneys have grasped a hold of this. They understand it probably better than defense attorneys do. And that appeal can be very successful, that emotional drive.
That's a really good point on the social inflation angle, because we've applied reptile theory to the courtroom, but now we're seeing that anti-corporate resentment spill into the actual parts of society. So from an insurance standpoint, you're looking at reputational risk. On the more extreme side of things, you know, the unfortunate violence that took place against an executive last year. So it's not just hey, it's going to increase the verdict payout. Now it's also anti-corporate sentiment. Could that also be a claims driver too?
It very well could be. You're right. And as underwriters and product people, I'm not sure how you can combat that. It'd be very difficult to come up with a contractual solution to that. In other words, you can't change policy language for the most part to exclude certain types of policyholders. You know, I think the best thing you can do is sort of be aware as underwriters, is this risk I'm about to undertake one that might find itself kind of in the news for all the wrong reasons? And then ask yourself, is this something I want to put on the books? You know, social, it's called social inflation. It's hard to really quantify what the impact might be. There have been some studies done, I think, that can lead to numbers, right? Like, what does this as a percentage mean for our general liability premium book? And I think, you know, we've seen, I'm going to throw out a number, about 7% annual social inflation on basically all liability classes. As far as factors that can contribute to social inflation, Dave, do you think within the liability span of coverage, there are certain sectors or certain types of risks that might find themselves more prone to a lengthy claim settlement process that then would fall within that social inflation increase?
Yeah, absolutely. And before getting into the industries or the specific LOBs within casualty, another key driver that may be one of the precipitators of those larger claims is third-party litigation financing.
Very true. We didn't touch on that. That's a good point, Dave.
And that's one with the most concrete data points where we can actually identify what are, and to take it back a step, TPLF, third party litigation financing, at a high level, hedge funds or investors can fund a lawsuit that they think is promising, that they think they can get a good return on. And there's actually data coming out now that shows what sectors are prime targets for them, where they think the most opportunity is. So to your question, Chris, you know, seeing where those investments are going really provides a good insight as to, okay, these claims might be brought to verdict. These claims might have more targeted advertising to get in a bigger plaintiff pool.
So that third-party litigation funding industry, I think, is about $17 billion a year. Where is that money going, Dave? Is it funneling into certain specific areas? Is it kind of broadly spread around?
Yeah. So anything with a class action potential has certainly seemed to garner a lot of attention from the industry. So to get even more focused on that, products liability, when a lot of users are purchasing the product, those are the ones that are prime for that type of investment, because it's easier than ever for a plaintiff's lawyer or a firm to target individuals that may have used a product, get them to fill out a form that probably takes them 2 minutes with an easy cash out at the end of it. And that's kind of been gamified and figured out. And it's led to some longer cases that went all the way to verdict, which runs the possibility for nuclear verdicts too.
Right. And the nuclear verdict that's a term we hear a lot in this space. And I think what that's generally referring to is larger than expected injury verdicts, you know, in the tens or perhaps even hundreds of millions of dollars. It's interesting in that we've seen those nuclear verdicts grow in number, I'd say, in the last decade or so. And it probably coincides to some extent with the rise of both social media, people getting their information from varying and disparate sources, and the reptile theory that we mentioned earlier. So you've got kind of a perfect storm here, right? You've got a changing societal attitude. You've got a real, I think, desensitization in the public with regard to large numbers. And then you've got a funnel of money in the form of third-party litigation financing that allows folks to keep a case in the courts longer than may have otherwise been possible, or even bringing a case at all that may not have previously been possible. So these three things, it's all kind of rolled together. It's not, in some ways, it's not a very manageable type of exposure. If you tamp down on third-party litigation funding, that doesn't really do anything for the desensitization of folks, and that doesn't really do anything against the appeal to reptile theory. So it's like whack-a-mole, right? Like where do you start to try to get ahead of this?
Yeah. You're talking about independent kind of events that are happening, whether it's anti-corporation thoughts and litigation financing. But social inflation really represents the convergence of all those things that points the arrow up as a whole.
And do you think there's any vulnerability, Dave, if you've, as underwriters, as agents, if we're growing a book of business that has sensitive intellectual property, trade secret information, is that kind of a book somewhat more vulnerable, you think, to the effects of social inflation?
Yeah, for sure. So early data that has come out about TPLF investment, 30% of U.S. Infringement cases brought in this country are actually backed by litigation financing. And what's come out of this is that it's not always necessarily a money play. Some companies are actually backed by either competitors or even foreign countries to discover trade secrets or key IP through the discovery process. So now we're talking about almost different agendas coming into play as cases are brought through. And that leads to, more tricky, I guess, claim scenarios for insurers and insureds. An insured might recognize that through discovery, they might have to reveal some things that they consider very important, very confidential, and they might want to settle the case to avoid getting that far. But an insurer may think, no, this is a winnable case. We want to see this through. So that's where it becomes important, I guess, to look at the terms, look at the policy, and who's really controlling the defense there. So for IP claims specifically, it's important to kind of know what happens as the process moves along there.
Yeah, I think as underwriters too, that's a good statement. You might want to be careful about the business you're writing, and this happens a lot in D&O and E&O professional liability areas. Who's controlling that defense, right? Because I mean, the real bottom line effect of the social inflation is an increase in claims costs, not necessarily an increase in judgments per se, but the length of time needed to settle a claim is the longer it goes on, the more expensive it is. So if you're an insurer in a position to control that defense, it could be in your best interest in some of these cases.
Mm-hmm.
We know too that I think the trucking industry has also, oddly enough, found itself in the crosshairs of social inflation. Are we aware of any reason why that's the case? It seems like you would think this would apply more to products liability, E&O liability, things like that, where you have potential for class action. But trucking seemed like an outlier. Do we have any data points around why that industry keeps popping up on social inflation radar?
It's a good question, and it kind of symbolizes the social inflation issue as a whole, which there's still some element of mystery. But I think we mentioned earlier the plaintiffs bar or even TPLF, they're good at finding winners, and it's pretty clear that trucking has produced really, really big settlements or judgments. And because of that, it's kind of set out this feedback loop of, okay, we should try more here. It seems to be paying out well. So it's almost been self-perpetuating in a way.
I think, too, maybe it has something to do with the fact that there are simply a lot of trucks on the road. And with more potential avenues for claims, obviously, I guess you're going to find yourselves more in the crosshairs of inflated judgments and spurious cases, sympathetic juries. Everyone's seen a big truck on the road. Like, how many times have you been driving and thought, oh, these guys, boy, they really drive like maniacs. Well, wouldn't it be nice to sort of get back at them, right? So now we're right back where we talked about before with reptile brain theory, and everybody wants to stick it to the man. So yeah, it's I guess it's a real convergence. For our listeners who are in that industry or adjacent to trucking, you're really going to have your work cut out for you in the next few years. I think I don't see this problem abating really in that industry. I think too about other lines of business or other types of insureds. You have medical products, aircraft product, things like that have traditionally been a little high risk, probably even higher risk now, with the theory that any individual claim, though it may have been bad before, now has the potential to be much, much worse. As underwriters, I think you really want to pay attention to your basics We talk a lot about underwriting 101. Well, an underwriting 101 could serve us well in this kind of casualty environment. If you were nervous about a risk before, you should probably still be nervous or even more nervous about it today. Make sure it's priced right and your terms and conditions are airtight. Dave, we're moving on away from sort of industries that are susceptible to social inflation or sectors of the market that are susceptible to social inflation. We think about underwriting. What are some of the things we can do as an industry to help stem the tide or combat the tide of social inflation?
So the industry as a whole, one of the big adjustments we can point to pretty definitively is the big move towards non-admitted, non-standard insurance markets the last 5-10 years.
Very true.
For property, that's definitely understandable with the increase of catastrophes and the severity of disasters. But when that's happening for liability markets, that's a red flag that there's things going on, and that thing being social inflation. So one of the biggest trends is that shift to non-admitted markets. But as far as underwriting, at a more macro level, there's certainly things to look at to see, hey, am I writing an account that could be more exposed to the underlying currents of social inflation? And I think you touched on it earlier, Chris. If a defendant is seen as, a bad guy, to put it, for lack of a better term, that definitely increases their risk of a really adverse judgment. And then we also talked about the companies that have very confidential, very valuable IP. They might be more prone also to be brought to a settlement, not even, or brought to a trial, not necessarily for money reasons, but so someone else could see that IP.
Right, in the course of discovery. That's interesting. We talk about the length of trials and things in the courts. We may, as an industry, not pay $1 in judgment, but you could spend millions in defense. And, to the carriers, that's still money that's going out the door. And I think about overall, I'm somewhat speculating here, but I think overall, I'd say in the past decade or so, the pricing on liability hasn't really kept up with what we're seeing as social inflation. I think it's traditionally been that line, both on the D&O and the straight GL products and prem op side. It's been a little light on its pricing. And as I think about these types of claims, these are long tail events. We don't always know year over year what the impacts will be. But if you think about social inflation broadly as, let's say, a 7% annual impact to your GL pricing, and I look at the latest admitted products loss cost filings that ISO is doing, for what they're showing is pending for products across the country, I don't see a single state with a rate increase or loss cost increase being planned. In fact, I see a lot of states that are reducing their products rating. So I think as an industry, we need to be aware of the impacts of social inflation, not just on our types of accounts, but on our pricing as a whole, not at the account level, but at the book level. And I think, I would hope, let's not think, but I would hope that at some point this loss data is going to filter its way into the various loss costs that we're seeing. So I would say for those underwriters or those agents or those carriers who want to continue writing in the space, be prepared for rate increases. Be prepared for those rate increases to come in the form of loss costs. And I think we should be prepared as an industry to want to manage rate better in this space. Dave, any thoughts on the pricing of this as we move forward in the next couple of years?
It definitely ties into the flexibility of the non-admitted market. And that may explain, to your point, why the shift is happening. Because even if the loss costs filed are higher, it doesn't necessarily guarantee that the regulators will see it that way.
Very true.
And maybe that's happening to some level right now.
Yeah, there's few places you'd rather not be, I think, in the industry than in a rate catch-up situation where you're constantly trying to chase premiums, and you don't want to find yourself in a situation where you're having to year over year file double-digit rate increases. That's not going to be good for your book of business, and certainly in the admitted space, regulators don't like to see that. So I think it probably serves everybody's best interest to sort of stay on top of this now, in whatever form that may take, to avoid having to take sort of bigger bites of the pie, as it were, in coming years. And insurers and rate service organizations aren't the only entities that are facing this social inflation issue. What about the states themselves? Dave, are you aware of any jurisdictions that have taken any kind of legislative action to help control social inflation?
Yeah, right now there's 6 states that have laws in place that address specifically litigation financing in some form, which we've identified as a driver of these claims. And then one other state actually had a law in the books maybe about 10 years ago. So there's efforts being made. I think there's 14 bills proposed for the upcoming year to try and address. And what they really hit at is disclosure requirements with knowledge from the defendant that, okay, this is being backed by additional investor money. They at least have a lay of the land to say, okay, maybe we should treat this case defending a little differently than if we had known it was just brought by, an independent plaintiff. So
That's true. That disclosure could it could benefit. I think in a way benefit both parties. Specifically, though, I think the defendant has certainly the right to know that.
yeah, and even a beyond the statutory level, some federal district courts actually do have rules in place that require the disclosure. So if you're handling a claim, there is merit to venue shopping and identifying those courts to say, okay, if we suspect there might be some extra money coming in here, maybe we can get this into a court where this can we can at least find out for certain.
It's interesting, we talk about the number of laws. What we say about six states, 5 or 6 states have some law in the books today. Another 14 states proposed. Even if all of those 14 new bills get turned into law, you're still looking at fewer than half the states in the country with any kind of legislative solution to this problem. So I think there's still a lot of work to do. It'd be interesting to see, and I don't have this information for our listeners. I apologize. I'm kind of thinking about this as I go, but it would be interesting to see the population density versus where those bills are in force. If you have, states with smaller relative populations creating these laws, that's great, but that's not where the majority of the business might be. We would really be looking, I think, for states like the Californias, the Texases, the Floridas, the New Yorks, the Illinois to take the lead on this. And I know I haven't really seen a lot of that activity, especially from a place like a Texas. I don't mean to impugn their state legislature anyway, but it seems like something that they would want to get out ahead of. I know the APCIA has turned this into a big lobbying effort, social inflation, for the coming year. So I think it will be interesting as legislatures start to reconvene to see, does that number 14 go up? I would hope so, but it's just something I think as product people in this industry, we need to keep an eye on.
Yeah, and we can't discount that even at a federal level, there also are being efforts being made. Obviously, counting on that level of bipartisanship could be difficult, but at least it's hit a point where it's drawn natural attention, and there's an understanding of the importance to really get a hand of this issue.
Yeah, lawmakers, I think, are going to have their work cut out for them. You've got, on the one hand, you've got a big industry that people rely on, the property casualty insurance industry, that's being negatively impacted by this, which in turn leads to a negative impact for policyholders, right? It leads to reduced coverage availability. It leads to higher pricing. But also, I think you've got constituents at the state level that, they see industries kind of, like you said, as the bad guy. Like, oh, why are these laws being passed to help the big evil insurance companies and the big medical manufacturers and the truck makers? Well, I think it's kind of like the circle of life of insurance, right? Like if insurance carriers are healthy, then the markets are healthy and people can get coverage and it can remain affordable. I think once you start to lose that balance, then you have problems. And, in the absence of any kind of direct federal regulation, it's up to each state. So you could have policyholders being disadvantaged or given an advantage in different places, just kind of dependent on where they live or where their businesses are functioning. So it's still very, very, very fluid situation.
Mm-hmm.
So Dave, we've spent the last few minutes kind of talking about the big 4 questions, right? What do we mean by social inflation? Some of the factors that contribute to it, like third-party litigation financing, shifting in social cultural attitudes, desensitivity to large numbers, reptile brain. We talked about the industries that might be more susceptible to this phenomenon, or might lend themselves to susceptibility to increased judgments. And then we talked a little bit about what's being done or what can be done. As we wrap up, Dave, do you have any parting thoughts you want to give to our audience on this topic?
It's been very interesting, I would say, the last decade, kind of getting at the first, seeds of social inflation, where we were trying to identify what the what was. And then once that happened, it got into, okay, now we're starting to figure out the why. And understanding that, I've, just from an outside standpoint, a little bit inside, I've seen so much progress made on trying to tackle the issues that kind of underlie social inflation. So I'm looking forward, in the months and the years ahead to kind of seeing how the industry continues to adapt, bringing focus on it to non-insurance constituents and trying to solve a problem that ultimately drives up premiums and hurts society, and bringing social inflation back down to a more reasonable level has benefits for not just the insurance industry, but across the country too.
Yeah, I agree, Dave. And I think, like we talk about so often in this industry and the issues we've dealt with on this podcast in the past, it's really awareness, bringing the problem to light, and then letting folks in certain positions in our industry deal with it as they've been trained to. You have, underwriters need to take these things into account when they're talking about decision making and pricing, right? Like, what's this risk susceptibility to a potential large verdict? Is it the same as it was 5 years ago when we wrote it? Why is this particular account being shopped? Does it have a claim history? So there's things like that we need to consider. And I think too, as product developers and product managers, we do need to be looking at the contracts that we're offering. Are the terms and conditions supportive of effective claim settlement? Do we have any ambiguities in our language that could keep a case in the courts longer than is necessary, or lead to a case reaching the courts that might not otherwise have done so? So I think there's a lot of shared responsibility in our industry, both on the underwriting pricing side, on the legislative monitoring and product development side, to help sort of keep this under control. I don't think it's going to go away, but I think we're getting better and better kind of each month at becoming aware of the problem and hopefully helping manage it. So I think the next year or so is going to be very interesting. It's an interesting time we live in. I never thought we'd see the day when we talk about these kind of issues, but here we are. And I guess Dave, I really don't have that much more to add. Any closing thoughts for the audience before we sign off?
Yeah, it's a rapidly evolving issue. So some recommendations of entities or groups I follow to stay up to date on what's happening. APCIA does a great job communicating what they're doing in their efforts. Verisk has done a great job tracking and laying out what's being done to respond. And I've also seen really good correspondence from NAIC, III. So it's good to see the industry really working independently, but also in tandem to bring as much attention to this as possible.
Yeah, I agree, Dave. It's real. There's real signs of collaboration, across the industry, and I really can't put it in much better terms than that. So, I think with that, we'll put a bow on this one, Dave. Again, I'm Chris Accetta, VP Product Management at IAT Insurance Group, joined by my colleague Dave Geller, the Senior Product Manager at IAT Insurance Group. And this has been the What's Brewing podcast. Thank you all for listening, and stay tuned for a future episode.
Providing insurance answers together is what we do best. Thanks for tuning in to the latest episode of What's Brewing. Until next time.